incredibly good panel as always, and I will introduce you to them shortly. The topic today is alternates and mutual funds. So it is, I don't want to say versus, complementary, against, or for. I am just saying the topic is alternates and mutual funds, and I want to kind of use the expertise which is there on the panels today. So I'll go about introducing the panel. Everybody knows them actually, but I'm sure none of them need any introduction, but let me do that. So we've got Swaroop Mohanty. Swaroop's the CEO, actually no, the Vice Chairman and Group CEO for Mirai now in the country. And Swaroop spent almost 30 years in the industry. We all know what he's done with Mirai. So thank you, Swaroop, for doing this and welcome in.
Well, thank you so
Then
much for
we've got
having me.
Lakshmi Iyer. Lakshmi also again, I will let me reintroduce. 22 years with the Kotak Group, maybe 20 odd years with the mutual fund side, 2 years on the alternate side. Now she's the CEO for the alternate investment teams, heads investment product advisory for the entire wealth side. So thank you, Lakshmi, and welcome in again. And we've got Rushabh. Rushabh, we all know Rushabh, the CIO and the co-founder of Karma. Rishabh's also got almost 30 years of fund management experience, actually now more than 30 years of fund management experience. 17, 18 years with Karma, and he also has a Kotak linkage. So he was the CIO for the Kotak Mutual Fund for a brief while of 3 years from 2003 to 2005. So looks like we do have a lot of Kotak linkages today. So once again, welcome everybody, and thank you, gentlemen and ladies, for joining us. We want to keep it simple and compact. We'll probably want to wind up within about 40 minutes, and then we'll leave it open for 20 minutes for Q&A. You can continue to type your questions in the Q&A session, and we will let the panel probably express their views over the next 30-35 minutes, and then we will probably ask them more specific questions that whoever might have from the attendee side. So without much ado, let me just start. And since I have set the ball rolling with Swaroop, I'll probably start it with Swaroop only. So Swaroop, I don't know, 20 plus years in the mutual fund industry, if I'm not wrong. Tell us how's the journey been, what you've seen in the industry, trends, changes. There is, I'm sure 20, 25 years back, the industry was very nascent. I wouldn't say it's significantly close to the developed market, but I'm sure we are now on a much different path than what we were 20 odd years back. So just take us through the journey.
Yeah, it's been a journey. Thank you so much for having me. And it's special because it's with Rishabh and Lakshmi. All of us worked together at Kotak at one point of time, and those were our days. But when you look at the journey, it's been some hits and misses. I call myself a sad equity seller because of some of the misses. Just when you think that the penetration is beginning and you see an SIP book of 21,000 building in the market, there comes the big news that the net in the bank is just 80,000. So sometimes you reflect on what you've done in this 25 years. Maybe we've not been able to communicate the long-term nature of this asset class enough, or maybe when you look at it from the other side, maybe a lot of work left. But yes, the industry has gone through enough, and today I can safely say that whether it's from the product side or from the fiduciary side or from the beginning of reach of our products into the country, kind of a platform has been made, and today some of the products have reached a fair amount of track record for us to kind of stand up and say with conviction that yes, mutual fund sahi hai. So it's been a good sort of track record, but I'll sort of pause here by saying that the work is just about started. I hope the penetration kind of goes. You can divide the industry into two parts, like, you divide the world into two parts, before Christ and after Christ. For the mutual fund industry, it's before COVID and after COVID. Before COVID, almost 20-25 years of hard work by all of us gave us 2.3 crore folios, but post-COVID in 4-5 years, we've got another 2.3 crore folios. So what is happening post-COVID, thanks to the digitization era and the ability to reach more people, is looking very different from what it was just before COVID.
I hear some very interesting words, and I'll probably talk to you later on that. Fiduciary, which is something which is very interesting to me. You also talk about a sad equity seller in terms of you're still not happy with certain things which are happening. So we will have that conversation. But yeah, very interesting that post COVID we managed to add almost the same amount of clients as we added in the 25 odd years before that. Thanks. Lakshmi, you spend time across mutual funds, alternates, you are now also pretty much a banker. So in terms of the fact that I guess you sit in the bank, you sit on the asset management side, you sit on the advisory side. You tell us, how are things happened over the last 20, 25 years that you've seen this place grow?
Thanks, Rajneesh. Firstly, one common link between all three of us, Rushabh, myself, and Swaroop. Obviously, we are ex-Kotakites, and I'm still part of the Kotak ecosystem, having worked with the two of them. Obviously, ex-Kotak AMC, because all three of us worked in Kotak AMC. But I must tell you that, after witnessing massive boom on the AMC side or on the mutual fund side in terms of whether, when we started the mutual fund say a campaign about 7-8 years back, or getting the, what I call it, the SIP revolution, being the talk of the town, and everybody, jaise bolte na, bacha bacha janta hai types. So I think coming from that adrenaline rush and having lived through that moment and made that difference to lakhs and millions of investors, it's equally exciting and great joy to be now on the alternate side of the business. And even in the when I was on the AMC side, I used to wear a couple of hats. I call it double hatting and not moonlighting, because Kotak pays me only one salary and makes me do multiple. But the enthusiast in me obviously allows for donning those multiple hats. So here I am on the alternate side, having an outside-inside view of, probably every asset class by being part of the investment committee across an illiquid asset class like real estate to the most liquid asset class called equities. The one underlying thing I think is common in all of these journeys is the fact that the fiduciary responsibility is a non-negotiable. That's number one. Whether you sit in any platform as a mutual fund manager or as an alternate manager or anything else, that's a non-negotiable. And second most important thing, the way we know in fund management parlance or in Bollywood, bhav bhagwan hai. I think investors, whether they are in India or outside India, color of skin may be different, but fitrat jo bolte hai na, the nature is that sare returns ke dhani hai. So the more they see returns, the more they salivate. So that much more onerous a job on us as money managers to be the harbinger of risk-adjusted returns. So I think that is something which needs to be, probably reinforced. And I'll tell you specifically in the last 3 to 5 years of the market boom, I doubt barely any investor has seen any mandi ka mahal. So I think that is one interesting, turning point, as I would say, that we are in, where risk is getting, very, very easily traded for returns. And I think that is what we as conscience keepers, having traversed this journey over 2.5, 3 decades, should be the highest custodians of, to ensure that you can continue to say that Indian markets is sahi hai.
As always, see, Swaroop, I promise you we'll have an interesting conversation, and with Lakshmi around and Bollywood connection, I'm sure we will have an interesting conversation. Thank you. Bhav Bhagwan hai, I love that line. And I think you also made a point about risk-adjusted return. So these are two things which I will come back and have a conversation on as we go forward. I think very, very two interesting points. And obviously the fiduciary responsibility you also talked a lot about, and that is something in the alternate world we probably are still grappling with, and that's a conversation which one of my questions which we will go forward to. And I will not neglect our very own Rushabh on this. Rushabh, you've had a journey from alternate to mutual fund to alternate. So the 30 years, you tell us what have you seen? So what brought you back to the alternate space 17-18 years back, and what has happened?
I think my journey was interesting. I was very briefly with the mutual fund industry, so it's been largely on the alternative side. And from my perspective, I think the long road that we have all traveled in the last 20 odd years in the industry has, I think, been a very interesting. And my sense, as Swaroop mentioned, is that the journey has just begun. I think the complexity of the business is going to continue to increase, and therefore the regulatory environment is going to continue to become more challenging. My sense is alternatives is just starting. Right now it's very simplistic. A lot of it is basically long only masquerading as alternatives. My sense is that will actually become far more complex. Products will become more complex as the market environment allows it to be, because the complexity requires the investors to also understand the product, and also requires the markets to be able to allow those products to be run effectively. So my sense is that the complexity of the business on both sides is increasing, and that will continue to increase. That will also maybe pose a challenge for investors to be able to distinguish what is right for them, and whether they are large or small investors. My sense is everyone will have to kind of figure out what is the best way forward, and maybe that's where we will need a lot of help from the rest of the industry to kind of ensure that we keep the narrative simple and be able to explain maybe slightly more complex products as the complexity rises. Because my sense is complexity in products is only going to increase, and that's going to be a little bit of a challenge to take forward as we kind of move forward for both sides of the industry.
Thanks, Rushabh. No, I think I hear you. And so I guess this is also maybe coming from the experience of products that you would have probably seen globally. Karma, maybe at some point in time, I should have introduced Karma as well, but maybe we'll do that. I'm hoping that most of the people here know about us. But we've had a long journey on the offshore space. So I guess that's something that Rushabh's also alluding to, the fact that we've had global clients and we continue to see more complex products going around. And that is something I think he also alludes to, the fact that if you have to build complex products in India, you need to have complex underlying to be able to absorb it as well, right? So the regulator has to allow that framework. So maybe taking the cue from there, and also the fact that both Lakshmi and Swaroop mentioned on the fact that we are still evolving. Okay, let me go back to Swaroop only since I've started with him. Swaroop, so as a manufacturer, and you're a mutual fund manufacturer by and large, right? But nothing stops you from evolving into more, I don't know, how do you see, okay, I'll put it in a different way. As a manufacturer, as a mutual fund manufacturer, how do you see your product suite or you evolving in the face of all the changes? Maybe at one end you have passives, at the other end you have alternates. So very, very non-customized, very simple mutual fund somewhere in between the active part, and then you have alternate, which typically, as Rushabh also mentioned, maybe a little more complex to go understand. So as a mutual fund manufacturer, where do you see yourself going or evolving in this space?
See, I think when you look at the landscape, and somewhere I'll take off from where Rushabh sort of left, because when you look at the landscape of investors evolving, and finally it is evolving, because you'll have the bottom of the pyramid saying that I want participation in the market. Then there'll be a slightly evolved one who will look for rule-based, either in the form of passives or factors, as you may call them, or expertise in the form of fund management, whether it's alternate or mutual funds. That's the second rung, which is slightly evolved. And the tip of the pyramid will look at very, very evolved structured products, or at a different risk profile, could be AI or whatever disruptive. And that's how the investor base will form. As a manufacturer, one aspires to be in all spaces, right? In which form or what, that's a separate issue. We started obviously in India as a long only equity scheme. You can put it largely to what is called the large cap fund today in 2010-11 in our new avatar. That's kind of taking leaf out of our global book. If you analyze Mirae Asset at a global level, what is staggering to see is 27 years ago, what used to be a long only equity scheme today is a global investor in just 27 years. And in India, we're taking that path. Now, from an alternate perspective, let me give you a very interesting statistics. My entire fund management team, the equity fund management team, is from the alternate space. Not a single one is from the mutual fund space. And they don't aspire to do alternates on the mutual fund platform. They tell me, hum nahi karenge. And then I am nobody to question, or I do not have the expertise to question that kind of acumen. So from our perspective, we'd like to keep the mutual fund space at mutual funds, right? And their play across the risk profile of the product. Interestingly, Rushabh and Lakshmi, let me bring you back to speed as to some of the observation. In 2016, and I'm not selling my product, I'm just giving an example. We closed our mid-cap fund in 2016, October. And at that point of time, mid-cap investing was considered very risky. Today, 40% of the flows go into small cap funds. That's how the industry has shifted on risk profile. So clearly, some of the complexities or the evolving of the products that Rishabh is alluding to has to happen for investors now to take the second step. I don't think worldwide people invest in market cap products anymore. India probably is the only country which is investing in active, secondly investing in mutual fund space, and secondly investing in market cap products. So as all these start evolving, we as manufacturers also evolve. Probably through some of the other side, we like to do PMS and AIF, not that we want to be away from that. But on the passive side, yes, we will push the risk envelope on the higher side for sure. You watch some of our products coming out, we will push. I think with the Fang Plus, we have a 10 stock disruptive tech portfolio, which is lapped up by the Indian market without our intervention. So the simple point I'm making is, since the risk profiling at a ground level is changing, I think manufacturing is also getting ready to deliver on those risk profiles.
So before I go on to Lakshmi, I have one question, Swaroop. So you mentioned the fact that the world is moving away from capitalization based investing or something, but the world still looks at you as a particular manager, as a manufacturer. The world looks at you. Maybe Mirae has brilliant large cap. Maybe Mirae had a brilliant mid cap capability. How do you see convincing people that as a manufacturer you can evolve, or you have the base effect? And I'll ask Lakshmi that question also and what she thinks about it before she goes on the advisory side. But what do you say on that?
Yes, please ask Lakshmi, because I am asking Lakshmi for some time to meet her next week on this same question. Okay. Because I'll tell you where we come from. Our job is to build products, and people will only get convinced with track record. Okay. Our job is to build good products and build track record. When people will take conviction is up to people. We don't interfere in that. Right. And Lakshmi will bear with me when this statement, when we start a journey of interacting, she now on the product side and me on the manufacturing side, we will never go into her and say, this is my best product, please sell it. This is our basket. Whatever you choose as per your profile is your choice. If you don't ask us, if you don't choose us, it's okay. We'll come. We will only ask for time. Ki quarterly ek meeting de do types. But our aspiration is first to deliver products as per the ability of our fund management team. That is point number one. We will never launch a product which may not be to the strength of our fund. And there is no harm in standing up and saying this strength we do not have at this moment. Suppose it's very wrong to compare Mirae Asset, say, with Kotak Mutual Fund, which clearly has at least 5-10 years advantage on fund management infrastructure building. Fund management infrastructure building, correct me if I'm wrong, Rishabh, takes time. Getting analysts, building a full team at the back end is a time. So till you don't build that, you don't launch products, is something which we firmly believe in. While on the passive side, wherever there is an investable universe, I can create an index, and on that index through factors, I can give you n number of possibilities. So we will probably go berserk there. Ideation is unlimited there. And then this categorization of funds also limits fund launch on the active side. So first, once we build expertise, we launch fund. We just hired a very differentiated manager in Varun. He comes from a style which is completely opposite ours. So if we develop some strategies, we will. No, we will not launch a business innovation fund or some rotational sector fund. Those funds are not for us. It can be great for somebody else, but not for us. But so stick to your core, stick to your strengths and launch products, and be open and build track record, and then people will get impressed. We are the worst NFO selling team in the market. Period. And we take pride in that.
And Rishabh doesn't like investing in IPO, so I think that's why you are friends in common. Okay, Rishabh, you wanted to say something, or shall I ask Lakshmi the question?
No, so I'm going to ask Lakshmi the question, and this comes from where we left the conversation.
Hey, Lakshmi, my apologies, but Rishabh will do question now.
No, I think the issue, the two things, Lakshmi, you mentioned about the price and the risk attitude. You being now on the advisory side, you have a very different view of the world than being a product manufacturer. I just want to ask you a question. Why is, and this is, as you rightly said, this applies both domestic and offshore. There is no difference. Despite all the books which are written on risk return and, on diversification, when you see behavioral aspect of investor, the return chasing behavioral aspect doesn't change at all. And maybe I want to ask you a question. How do you see that in your new role? Do you see that there are still investors who can distinguish the risk return, the parameters in terms of where you are on the risk return scale, and going from where Swaroop left in terms of product. You see products which are kind of baffles your mind sometimes, that and we come from the same camp as Swaroop. We for 17 years did only one strategy. It's only in the last 1 year, 1.5 years that we have added one more strategy. So we also want to build a track before we actually start marketing. But the issue is that the markets are very different. The behavior of markets, people go out and launch new products and without any track record raise so much money. So my question to you is, how do you see this risk appetite, behavior towards risk, and the measurement of how to kind of put it across to the clients in their portfolios?
No, I think all of us are probably sailing in the same boat, Rishabh. It's very, very difficult to explain to any investor on why you should not behave like Vishwamitra getting lured by Menka dancing when you know that you have gone for tapasya and you try to do a different kind of tapasya. So I think it is very the bane of the markets or the industry today is that there is predominantly, and I must be fair in using the word predominantly because I cannot paint the canvas with one single brush, but the mentality is definitely very, very similar. If you are right there stacking on top of the returns and you are not being, one of the investors or on one of the cohorts of that investment, then the question arises, that wo FOMO wali feeling aa jati hai, the fear of missing out. Maybe subsequently people realize that, when something, unravels or whatever, or the ingredients to getting those returns were not the right way or kosher way, that is when the JOMO feeling comes, which is a joy of missing out. By then, the train is already missed. And I'll tell you one very classic case with an anecdote. Since I wear a couple of hats here, also at the alternate asset managers on the product side, when we launched the private credit fund, for example, now private credit has become like tomatoes being sold all seasons of the year. Every thela has got one, bucket full of, or, one thela full of tomatoes. But nobody wants to understand what is the underwriting standard, what is the underlying risk parameters, what is the governance structure, what is the security. Nobody wants to understand that. Everybody is only interested, or most of them are interested in understanding, अच्छा gross yield कितना है, अच्छा तुम्हारा gross yield इतना है, तुम्हारा expense ratio इतना है, तो तुम्हारा net return. So it is getting commoditized and getting akin to a fixed maturity plan, which I used to do in my erstwhile avatar as mutual fund manager. And but look at it, that is exactly not the way of identifying or evaluating a strategy. So effectively, what is happening is that the short-termism, I call human beings, typically investors have Gajni memory. Gajni ko bolte short-term memory loss. If you've seen the movie Gajni, he had to write everything on his footnotes so that he remembers what he has just heard or seen a few hours back. So human beings on the investment, parlance are also very, very similar, where the recency bias has caught up to a much larger extent than the risk-adjusted metrics that one needs to actually look out for rather than mere chasing returns. I must tell you that to some extent, what we see around us, multiple aggregators who put up these numbers are also, I won't say entirely, but also to some extent responsible, because financial literacy is not fully entrenched in India. We have to accept it. Even if today, if you go to some parts of the country, and not necessarily only hinterland, okay, by the way, still that 10 rupee myth, and I know it's bad news for Swaroop, but still that 10 rupee myth is very, very prevalent. 10 rupiya sasta hai, 20 rupiya wala kharidne jo mehenga hai, it's still there. You will not believe, I still get calls from avid investors who avid with money, okay, not with knowledge, who call up saying that I have 1 lakh of rupees, sasta stock batao na, kaun sa kharidne ka. I said, you only do sip, I don't give you tip. No, this is genuinely conversations I'm still having right now. So I think to cut the long story short, the more one starts harnessing and talking about risk-adjusted returns purely rather than showcasing, oh, this is my return track record, the underlying ingredient, if to your constitution, I can offer you a masala dosa because masala has so your body can take the carbs, it needs the carbs. Maybe for Rajneesh or Swaroop, those carbs are not required. They just need proteins. So maybe what is the right fit for them is dosa. Dono mein dosa hai. लेकिन ingredients are really different. So I think once you start acclimatizing yourself to that fact, you will be way more happier. And on a Bollywood anecdote, for example, play to your core strengths, from a manufacturing side, that's also therefore very critical. You've seen the movie Archie? Anybody? Nobody? Very bad. It's for the younger generation.
You're the young one.
It is for the younger generation, but you had Shah Rukh's daughter in that. You had Sridevi's daughter over there. You didn't have the people who've been in the industry for 3 decades and 4 decades. These are people whose age is also not touched the 3 decades. Those were the movie people. Those were the people who were acting in that movie. The reality is, because Archie is a teeny book. It is read by school students. It's read by, just people who are getting into college, those kind of people. So therefore, for that kind of an audience, this Starcast was very, very important. So playing to the strengths, therefore, even from a manufacturer perspective, is absolutely of paramount importance. I would probably not be mentally attuned to see a movie called Archies, but it has maybe, Shah Rukh Khan or an Amitabh Bachchan. They may be great actors, but you have to play to the ball. I think that's very critical.
Very good. Thanks. No, I think, Lakshmi, you highlighted one very interesting point, and I'll probably ask you a little more on that. So this risk-adjusted returns, you talked about aggregators, and you talked about the fact that how does one really evaluate the performance of an alternate fund? Because the data, see, mutual funds is still fairly transparent. There is a lot of data available for one to look at. But you may choose to ignore the mutual fund data and still chase only short-term returns or recency bias. But in the alternate space, are you actually seeing the availability of verified, verifiable, comparable data?
No, it is apple and custard apple. दोनों में apple लिखा है, so people think it is the same fruit. But the nutrition factor of an apple is so different from a custard apple, right? For a diabetic, apple is still okay. For a custard apple cannot be okay. So alternates also somewhere comes into the same bucket. Category 2 and category 3 people very seamlessly confuse, use similar kind of metrics. Most of the listed, or I would say all of the listed equities come under the category 3 bucket, whereas category 2 has got a private credit fund, stroke, a PEVC fund, a late stage, early, all sorts of kind of things, and it all gets mixed into the same thing. The need of the hour definitely is some homogeneity, some kind of similarity, which we are definitely working, and giving tangible inputs also to the regulator. But as I said, Rome was not built in a day. The AIF industry today is growing at a CAGR of 35 to 40%, where the mutual fund industry was growing probably 10, 15 years back. And obviously the pedestal in terms of size and scale today for the AIF industry is a pygmy compared to the Goliath, which is the mutual fund. So it will take its time. I remember having 10, 15 years back, worked very seamlessly with the regulator and the industry body mutual funds to get homogeneity in fact sheets. It was a Herculean task. I showed French fries, Swaroop showed German fries, and probably ABC fund manager showed Spanish fries, and all three of us were showing potato performance. So, that's the difference. So I think we've come a long way from there. And I think the AIF industry also will follow suit.
Okay. I think that is something which is we all hope for, because as Rishabh mentioned, and you also mentioned the fact that the underlying people are not understanding what is the kind of risk they're taking. And in an alternate space, and especially the way you talked about private credit, PE, VC, where everything is anyway fairly illiquid or very valuation third-party driven, unlike a public equity or even a public debt, for example, which, those valuations are there daily basis or even, real time. So that's something that I guess will take some time to evolve. But just moving on to Swaroop. So, you talked about capitalization base, you talked about the industry evolving, but there is another level of thought and maybe fear, which also has played out in the developed markets as mutual funds become very large. Alpha generation starts to become a lot more challenging. Is that something that you see in your funds or in the industry, or how do you tackle that? Is that something that you worry about? And maybe that is what is also something which might lead people to either passives or the alternate side, one of the two.
See, at the end of the day, this business of ours has just one rule. Okay. What is right for the investor is right for us. And you base it around that, everything becomes easy. Till the time you can generate alpha, you're great on the active side. If not, then the market will take its own course. I mean, if you look at this whole debate of alpha versus market, and you look at the Australian market is a very great example because these changes happen either in two ways. One, the regulator comes and makes some changes, or the investors sort of notice and make the respective change. In Australia, the investors kind of picked up the thing, and there's no regulatory intervention in this. Now, as we progress as manufacturers, we should stand tall and say that we, on the active side, should be able to deliver alpha. And at this moment, the beauty of the Indian markets is there are enough managers on the active side which can generate alpha. At the same time, due to the categorization of funds, and especially on the mutual fund side, there are that many ideas you can put on the table because the regulator has come and put in the categories and everything. So that's why at this moment, I feel a lot of new ideas will come on the passive side rather than the active side. Please, at the underlying today, while we mutual fund guys boast of 4.5 crore folios, there are 9 crore demat accounts. So actually the number of investors is skewed on that side. Hence, for us, the ETF play actually is a big play. If you ask me, the market is bigger there, right? But this is a market fraction which will play out on its oars. The more the inefficiencies, and I'm getting into Rushabh's area of work, the better for fund managers, right? And more volatility, more the opportunity. We believe that the volatility is there. At the end of the day, if you look at, say, the last 4 or 5 years, especially on the mid-cap side, the number of new industries which have added, including us, the asset management business, is only on the mid-cap space. Hospitals are mostly on the so. As the market also broadens, we are still a little bit away from that juncture. So we are in a sweet spot. From an investor perspective, the active guys will perform. You'll get great ideation on the passive side. There are enough alternates now building great track record like yours, sensible track record. I mean, when talk about track record, sensible track record. So at this moment, debt investing is also fantastic. The credit space is also evolving. So the investor is actually the best, is spoiled for choice. The choices are developing. As manufacturer also, the opportunities are large at this moment.
Thanks. So I hear you say more that you could probably move a lot to the ETF or the passive side. Rushabh, your quick thoughts on this.
No, I think Swaroop is absolutely right. My sense is the investor is spoiled for choices right now. The amount of and which is right. I mean, which is how all industries evolve. It will fragment before it consolidates. So we are fragmenting right now because we have so much growth. All growth always brings more players, more people into the industry, which is happening right now as we grow. And the industry has been growing so rapidly. So there is a large opportunity which will attract newer players and which is good for the industry and the customers. Eventually, it will consolidate as it becomes more matured and as we go through maybe slightly more regulatory hoops in terms of the industry. My question, maybe I'm asking too many questions to both Swaroop and Lakshmi, was what Swaroop kind of really kindled something in me. The maturity of investment teams. That is I've never heard that topic being discussed with any investor except for a few very evolved investors overseas. And that is the topic which to me is closest to my heart, that at the end of the day, this industry will be built on process and investment teams, and which is something which we don't talk about at all. When at least we don't hear those conversations in the Indian markets. We hear those conversations a lot in the offshore markets, and that's where maybe somewhere we also feel that a greater focus on process and teams and maturity of teams will be very critical to the longer term success of the industry. Otherwise, it will become, kind of a flash in the pan kind of thing that you do well in a cycle and the next cycle you're not even visible. So, maybe to both Lakshmi and Swaroop, how do you see that bit of it evolving from, because you speak to so many investors of various types, How do you see that evolving in the Indian space?
Who do you want to answer, Lakshmi or me? Whoever. I mean, Lakshmi, ladies first, then I'll
She can
follow.
start, because she
Okay,
has.
I'll start from my end.
Yeah, and
I'll
then
give you
because we
our
are
view.
manufacturers now, so maybe you can.
Yeah,
but it's very important that I
Yes,
will come
yes.
to that because you mentioned that, and I kind of picked up from that.
Fair. I think, when you look at any asset manager and especially building a journey in asset management, the name of most of the asset managers will read XYZ asset manager. So it's a business of fund management. That is the core, right? So when you build that core, how you build the infrastructure, how you build each manager within your fund house, how you build the analyst backup to that fund house, what is that software backup that you put behind it, whether the entire process is automated or not, all that built the broad, what can I say, fund management infrastructure. And we take pride in the fact that if you look at our team, a lot of our managers now started as analysts. When they start as analysts, you then build them up, and from there identify some who can become fund managers, and then probably put them as co-managers, as apprentice for some time before handing them over a fund. So that is a process which we follow. And like Rushabh rightly said, finally the process will outweigh everything, not taking away anything from the stock market, stock picking ability of any manager, but the consistency of that process is what will play out over a period of time. And I dare say some amount of it is getting noticed at this moment, that a fund house has this breadth of analysts. Within the analysts, what are the pockets for each kind of sector? Do you have that many man hours in those sectors? It's something, at least on the institutional side and some of the family offices, we are definitely getting those questions, which is fantastic. Whether it's happening at the product level across the scene, I think a lot can be done more. And my expectation from Lakshmi, purely from going from our side, would be put that in place, probably the flag bearer to also get into this whole thing. The other part, Rishabh, to answer your question, is whether the fund manager is actually upholding the fiduciary responsibility consistently, something which should also be taking into consideration. I don't think that's really a consideration at this moment. That's where I think a lot can happen, is my submission. But on fund management infrastructure, yes, a lot of questions have started. And I would dare say in the next 4 or 5 years, a lot of selection of products will be tilted towards that. And that will play a weightage, is what I'm hoping for.
Thank
Lakshmi,
you.
your thoughts?
So I would say, Rishabh, see, a couple of things. One is form is temporary and class is permanent. And that class comes only out of expertise over monitoring something or someone for decades. Have you been to Swati restaurant in Tardev?
Yes.
Bhatia House
That
like
we have been to.
Yeah.
We've not watched the
Yes.
movie, but we have been to.
So,
Swati place.
हाँ है ना, तो Swati stands for consistency. It's been
Maybe
there.
Swati in Ahmedabad is better.
Yeah, I know, but Ahmedabad, बरसात के दिन तो I'll drive to Tardev, no, from Bombay. अभी क्या करूँ?
बराबर.
So the Swati, definitely Ahmedabad is way better than Bombay, but see, Swati stands for consistency. And that consistency doesn't come out of a run-of-the-mill restaurant which opens up in BKC. So there you will go for the flair value. जाके देखोगे, अरे क्या है, उसने NFO किया है, चल ठीक है, उसको इज्जत के नाम पे तुम उसको दे दो 10 रुपया 20 रुपया kind of a thing, because you know the fund house. So for example, you know the promoter or the owner of this chain who has launched a restaurant, तो जाके इज्जत के लिए जाके देखो. Are you going to be a repeat customer? That will depend on your experience and the quality. So I think that analogy of food, and I'm bringing food because it is mid-time snack time now. So from departing from films, to give you that example, that is very analogous to fund manager performance also. So it's very important to identify the right kind of talent, in and we call it infrastructure, obviously, in fund management parlance, rather than do hit or miss, trial or error, because that cannot give you durability. It might give you success with one fundraise, and in alternates, Rishabh, you are aware that it is about multiple fundraisers. You can launch, one fund, and on the piggyback of that, if it is consistent and good, you can launch a series 2 of that, because obviously there's a mandatory closure as far as category 2 is concerned. And category 1, once it touches 1,000 investors, again, category 3, sorry, you have to again launch another one. So I think that's exactly where we are coming from. And therefore, considerable time and energy of any fund management house or fund house should actually be on getting a very solid investment team and with a very solid backup. I think that is extremely, extremely important, so that the reserve players who can double up as research analysts, etc., they also need a career grooming, right? There may be some people who might be very contented being research analysts all their life, but there are, equally to Swaroop's point, there are people who would love to be groomed into, fund managers. When I joined the industry, I joined as a research analyst. So, and as I said, there are some who joined with me who are still research analysts in thought, deed, and words. But some people need to graduate and want to graduate. So how do you give them that growth path and that career path? And that will obviously happen. And see, ultimately, I keep telling this to everyone, genuinely, fund management is not rocket science, because none of us are scientists. So it's all about consistent application of principles, what you have learned, derived, or you've learned through your, academic years, and put that into practice and be able to judge and, monitor certain events ahead of the pack. So I think that is my view, having a novice kind of a team to be able to get with more class and pedigree, definitely.
Thanks, Lakshmi. Okay, I am just so loving this conversation, where I didn't realize we are almost 45 minutes into the conversation already. I'm now going to get to the crux of what we started with. So, since Lakshmi has already spoken for a while now, I'll start with Swaroop again. Why, how do clients look at alternates and MF? How do they build a portfolio? How do you think they should look at this in their own portfolios? And I'll talk after this, ask Lakshmi the same thing, because we've all highlighted the fact that there are some places people are not evaluating it properly. Some people, the data is not available. Some places, it's just become a fad or a trend going forward. So how does a client think about all of these things? And there are some few questions which are already out. So I want to ask this, this overlying thought, which finally boils down to how should a client look at this?
Yeah, I mean, I have a very simple take of it. Portfolio building is an art. It also involves a little bit of science. Maybe when you start, one starts thinking that these are return generating avenues, but as you grow as an investor, you realize that it is a risk mitigation process. The closer your portfolio is to your own risk profile, the better one has as an investment experience. And that's how one should approach building a portfolio. And then portfolio has to be a mix of what is right for you. If there are alternates which are great for your portfolio, you should have them. And if there are mutual funds which are doing something different, my only request is don't get into similar products. There are enough differentiating products across verticals, across different classes. Now, when you build a portfolio, there is the core part, there is the satellite part. The core is obviously the solid part. There, either you choose a basic fund or you can have a very strong pedigreed manager like, say, Rishabh, who will cater to the core part more efficiently. Maybe look at the costs a little bit, because costs do matter over a period of time. And which is the best cost mitigated product on either side should form the core part. But on the satellite side is where people can be a little adventurous and look at differentiated products. And there, whether new ideas, differentiated ideas, which can give slightly higher alpha, should be encouraged depending on the risk profile of the investor. And I'll kind of leave it at that. I'm indifferent to whether one is selecting mutual funds, alternates, passives, art, whatever. Nowadays I've been exposed to the art market a bit, and it's a very, very structured market. It is a very, very qualified market, extremely transparent if you get to the right people. So each to his or her own. How you build the satellite part can be a little more adventurous. But at this moment, when you look at the country going from X to Y, doubling the economy, don't discount the core of your portfolio in generating wealth. And last few years, I'm seeing that getting discounted. Your large solid companies can become even more solid and larger. Please don't mistake that part in this sacrifice towards return generation. Finally, people do not understand, and I'm making a blanket statement. Please don't take me otherwise. The mathematics of generating 11-12% compounded over 15 years is a lot of wealth. Please don't discount that calculation at all.
Lakshmi, I think core and satellite, sticking to your basics in a very solid way and then expanding your world into maybe something exotic or something different or something adventurous is what you said. What is your take on this?
So, have you heard of the saying कि एक म्यान में दो तलवार नहीं रह सकती? You heard of that, right? Here I'm saying that investment की दुनिया में एक म्यान में दो तलवार definitely रह सकती है, which is combination of actives and passives, combination of MFs and AIFs, combination of traditional equity long only funds, long and short funds, and the PEVC world funds which are coming as part of alternates. But the decision whether you need to stop at, again, sorry, pardon the foodie in me, but golgappe mein ek plate mein 6 puriyan hoti hai most of the places. Okay, some give you 7 also, which is the dry one, but your appetite and your liking of that pani puri will decide whether you are content with one plate or you can go into the second plate, and people like me can actually have the second plate also and not be apologetic about it. So I think that risk appetite and that khacha of yours is something which you need to compartmentalize. And I would completely agree with Swaroop that keep the adventurous second plate as a tail end option. Primarily, you should be content because the diminishing marginal utility of these, whether it's investments or otherwise, is very much the same. So have a core focus where India is a growth market. And I say this very, very dispassionately that being the growth market and more importantly, an alpha market. 2 out of 10 funds in the US outperform the index. In India, it's the reverse over long-term cycles. So therefore, it is very important to focus on alpha managers, build a nice core portfolio which is focused on Indian equities, have these small sprinklers, as I say, in the form of all other investments, have those sprinklers because those sprinklers also keep your gray matter satiated. Alzheimer's disease nahi hona chahiye na old age mein. So to keep you satiated and to keep thinking of newer ideas, keep engaging, and obviously that is purely a function of how much vitamin M, which is the money that you have at your disposal. If you are a first-time investor or a newbie coming into it, just stick to plain basics. But of course, as I call it, if you're done with pani puri, then it's time to try pani puri with vodka infusion.
I think phenomenal. From both of you, I hear that, let whatever exotics come in, let whatever alternates come in. If your core is not strong enough in terms of your investment world, and that means that it simply, in India's case, maybe public listed equities or even maybe to a certain extent, certain amount of debt. If that is a public debt, if those are the 2 or 3 core things in your portfolio, and you understand the risk associated with it for the alternate side, then go for the other one. Otherwise, India, the market, the way it's growing, even with your core portfolio, you can deliver significant wealth creation. I think that is something that I hear very clearly. Rushabh, I'm not going to ask you this question because I'm going to go to Q&A. Apologies for this. We are running short on time. So Lakshmi, the first question is to you. Lakshmi mentioned no mandi in the market in recent years and need for risk-adjusted returns being a fiscal and fiduciary responsibility of all fund managers. We are now seeing a strong correlation of MF delivering higher returns on the back of higher beta. Is this the signal of a bubble or correction? Does this also signal a need for greater investor education on other metrics than 3-year ARR to be nuanced like metrics like beta, Fortino, Sharpe for investors to make the decisions? So basically, how should you look at educating investors on just looking beyond simple IRR numbers and the mutual fund delivering on the back of a higher beta? Is that a sign of bubble or correction?
So it's already been, displayed. There are most of these measures, you already see it being disclosed across all mutual funds. So it's a publicly available information. I definitely urge investors must definitely track how the returns are coming from. It's not just important to see the sweetness in your dessert, but it is also important what is the ingredient used as a sweetener: refined sugar, cane sugar, stevia, plant-based, all of that. And that will determine the amount of risk hazards that will get added to your health, in this case, your financial health. So yes, there is no two ways. Risk adjusted return should be the way. And I'm pretty sure that there are very standardized ratios available in all public domain, including the fact sheets and the websites. It is definitely investors' prerogative to be aware of all of these data before taking your investment decisions. And please, please, please don't get carried away only looking at returns.
Okay. Swaroop, the next question is to you. Two quick questions for you. Huge fan and investor of Mirai LMM fund. Market leader, 23%, 10-year annualized returns. Talking about aggregators as brought up by Lakshmi. IndMoney ranks Quant in the category as number 1 versus 16 for Mirai. How do you respond to more electronification Quant-based mutual funds? How confident are such algo-based trading MF quant funds for delivering strong returns during cycles bull to bear and periods of high volatility? So basically, he's asking you, आपका large and mid cap fund is a great fund. It's launched and it's still ranked number 16. And you think all of these algo-based funds can deliver over periods of time?
Yeah, two parts. I think, first of all, thank you so much for recognizing the fund. We believe it's a very special fund in the Indian mutual fund market, managed by Nilesh. It's the only open-ended available managed by Nilesh. So for us, it's a very special fund. I'm invested in that fund from 2011, from the time I joined. My money is up almost 12 times in that fund. So I've done the hard work in that fund. From here on, a 10-12% return on that fund can give me substantial compounding. So that's how investment I would approach in that fund. Secondly, when you look at algo-based funds, I'm a big fan of rule-based investing. You cannot take away the fact that rule-based investing just takes away some of the underperformance risks of active managers. You cannot take away the fact. So an algo will act irrespective. There is no subjectivity. So when you put algo on one side and maybe the passive investing very similar, the merit of them repeating their own action over a period of time in periodic rebalances does play out. They will be tested in cycles. Some of the large algos worldwide were tested during COVID. It is then that, as an investor, do you have conviction on that algo or not? You will be tested more than the algo. The second part is, if you've taken conviction in an algo, take a very early position. Right. Most of the times what has happened, and I'll give you a great example. Last 1 year, industry has piled on small cap money. And if you look at the 6-month return, I'm not allowed to say, but just for the discussion, in the last 6 months, mid caps are thrashing small caps, multi caps are thrashing small caps. So while investing is in its own way, from your perspective, more often than not, you will be tested in your conviction on those theories. The theories and practice will remain, is my submission. Yes, big fan of quant investing. Hopefully, I'm looking for a good quant talent to add on our side. Maybe we should get a quant fund at some point of time. There is no denying the fact that as a manager, it is a progression for us too.
Okay, and one more question we have time for, Rushabh. It is asking you and me, so I'll let you answer. Rushabh, Rajneesh, do you see a disruption in PMS catering to newer investor, millennial, Gen Z, first generation investor with lower ticket sizes than 50 lakhs?
Yeah, I think as we are speaking, I think SBI has announced a category of product between a mutual fund and a PMS stroke AIF. I don't know, disruption, my sense is, yes, some consolidation will happen. Obviously, it's a part of the cycle. We are in the cycle where we are seeing fragmentation. We will see consolidation over time. And of course, we'll see newer products. My sense is the complexity of products on the alternative side is going to increase tremendously. As Swaroop mentioned, quant, my sense is quant as a strategy on the alternative side will also come through. You've not seen enough long short. You'll see a lot of different kind of products catering to different kind of investors with different kind of risk appetite and different kind of portfolio requirements. So My sense is this journey is just begun from a PMS AIF space, and we have a long way to go. As Lakshmi mentioned, maybe we are 10-15 years behind the mutual fund industry in terms of evolution, and we think that it's just a starting point. And more importantly, from our standpoint, you'll have to build processes and teams to be able to capitalize on this. This is not going to happen overnight. This is not going to happen tomorrow. This will happen over the next 5, 10, 15, 20 years.
Thank you, Rishabh. I think I just to kind of close on to that, I think this 50 lakh ticket and this new gen will continue to work with multiple kinds of managers as they come in, and maybe more online managers who come in as well. I think some people will evolve towards higher ticket, some people will go towards the lower ticket, but I think there will obviously be a market for differentiated products. And as that evolves on a regulatory basis, I think they will continue to happen. Last question. My question to Lakshmi and Swaroop on new category which SEBI is talking about with higher ticket size. Last thoughts on both of that, quickly trying to fit that in.
Lakshmi.
I know we are running out of time.
So, the threshold is right now 5,050 lakhs and 1 CR. And I know that there is this raging debate and thought to have one more category of higher, but then that will kind of blur the lines between what a PMS does versus what a mutual fund does. And obviously AIF is in another orbit at this point in time in terms of ticket size. So too early days to comment on, and how the lines will still be pretty kosher and sacrosanct. So we need to see how it is going to evolve. But as it stands today, the risk profiling is significantly demarcated and differentiated for each of these offerings. And all three are very, very potent and kosher vehicles for one to participate. We have seen ticket sizes, not just in lakhs, but even in crores coming into mutual funds. Which has been a time-tested, diversified way of ownership of asset classes, and I don't think even if you raise the bar in terms of ticket size, that thought process or that philosophy is going to go away.
Thank you, Lakshmi. Swaroop, last point. You're on mute.
I think at a conceptual level, products have to be differentiated as per investors. And that is not happening, is my submission. If you look at this country and you look at the roads, the reason a metro comes is to take cars out of the roads. But if you price the metro as the same as the bus ticket or a cab, then you're going to get everybody back on the road. So if you're going to create a different category, then those risk factors and the products that can come there have to be completely different for that risk capacity of that investor, right? Now, when you look at India at this moment, I was attending some family office summit where this data came out that out of 10,300 family offices in the world, some 350 family offices are in India. But the next 5 years, India is supposed to register the highest number of incremental family offices. This is probably one of those countries where wealth generation is pretty serious. Hence, the evolving of such products is also warranted. My only submission when you start conceptualizing this product, the risk profile and the styles of these products have to be differentiated. Problem happens when there is a blur. I mean, when AIF start working in mutual funds and mutual funds start venturing there, insurance sells as mutual funds and vice versa, then the investor then does not get the right thing is my submission.
Perfect. I think that exactly what we also think, but we are completely out of time. Lakshmi, Swaroop, Rishabh, thank you so much. I could continue this for another hour without blinking an eyelid. It's been so interesting and fascinating. Thank you so much for being there. I think hopefully people on the call got some insights onto how they should look at alternates and mutual funds. Thank you for highlighting the fact that there is core, there is growth. So there is money to be made in this country, just be sensible. Thank you so much once again, guys, and have a lovely evening.
Thank you for having us.
Thank you.
It's such a pleasure.
Thanks.
Bye.